Piper Sandler is out with downgrades on both Snap and Pinterest on concerns about the worsening advertising market and competition from teen favorite TikTok. Joining us now is Piper Sandler senior internet analyst Tom Champion. When you see a pullback in any type of advertising dollars or digital marketing dollars from companies in such a wave like we are right now, what does that perhaps entail for some of these companies that you're covering here that are extremely dependent on those ad dollars continuing to flow in?
Yeah, we just have to peg expectations at a very cautious level. There's a lot of uncertainty out there. What we saw from Snap 2 weeks ago was that they pre-announced the second quarter, and they said growth was going to fall below the low end of their guidance range they set for the second quarter. They forged those expectations just a month prior. So it's a very dynamic environment, and it's changing to the worse.
And what's interesting about your note, Tom, it's Julie here, is that you say typically these stocks don't re-rate until after the digital ad market has bottomed. And that's saying something, considering how far these stocks have already fallen. So how do we figure out when the digital ad market, that is, bottoms?
Right. Well, we have to see evidence to the contrary that it's not continuing to deteriorate, right? So if advertising is a lagging indicator and a lagging business to the economy, right now what we're seeing is inflation concerns, higher interest rates, potentially a consumer that is pulling back, and that will have knock-on effects on the ad space, we believe. So until the broader economy stabilizes and finds a floor, we don't think the advertising business can improve. And right now, our macro team here at Piper Sandler is quite cautious on the economy, thinking it may not bottom, it may not rebound until next year. So for us, we had a relatively sanguine outlook on the ad space coming into this year. That just no longer makes sense, and we decided to get more cautious.
Tom, are investors not appreciating the power and growing influence of TikTok?
It's a great question because TikTok's a known at this point. It's very large. It's growing very fast. You've seen Mark Zuckerberg talk about it on Facebook earnings. But they're not public, so they don't report every quarter. It's a little uncertain what their financial results look like and the impact. So what we're seeing is the second derivative impact on names like Facebook in terms of what management is saying at the quarter, and potentially maybe a more profound impact on Snap.
For a company like Alphabet, and particularly Google and YouTube, where they see the majority of their revenue come in from and on those advertising spends, have we seen anything in the data to suggest that even if there are still spends taking place, it's for a smaller portion or a smaller size? And, with that inventory, that turnover, even with TikTok, as we were mentioning a moment ago, is there another platform that becomes kind of the de facto for a cheaper run campaign that is still effective?
Yeah, it's a great question because the changes that Apple has made over the last year have significantly altered advertising campaigns and processes, and both the platforms and the advertisers are still gaining their footing in this new environment, and it's created a lot of uncertainty in pricing and efficacy for much of digital media. I think our view is that Google is the best house in maybe a deteriorating neighborhood. That all our checks indicate that the product continues to improve. We hear great things about Performance Max. That the efficiency and ROI that Google is producing remains extremely strong, that their sales effort and their consultative approach with clients is very, very helpful. You know, as it stands in our outlook, we continue to rate Google overweight. We think it's we are most constructive on Google, you know, with respect to the entire space.
You know, it's interesting because what you're talking about is execution, right? That Google in some ways is doing it better. But I wonder as well, when you're looking at the differentiator for a Google, if there's also more value now than ever to being, you know, the biggest tent, if you will. In other words, when I think about a Snap or a Pinterest, it's a more targeted audience. Is it more appealing to advertisers at this point to have that wide exposure to a big audience?
It's a great point. I totally agree. I think it is plausible that during the pandemic and immediate pandemic aftermath, when there was huge amounts of incremental advertising spend that materialized from e-commerce and these various spaces that benefited during the pandemic, that potentially Snap and Pinterest over-indexed on the incremental spend. As spend normalizes, it is consolidating back to the mega platforms. You know, Google is certainly one of those. I think Facebook is perhaps better positioned now that spend is normalizing. They are simply extremely large. You kind of can't not be there in a lot of ways. And so while Google is the best place to be right now, they're executing extremely well. I think the situation may be improving for Facebook as well, and scale is a huge part of that.
The Department of Justice is expected to release a report tomorrow detailing possible actions by the U.S. concerning criminal use of cryptocurrency. This comes amid increasing warnings about a crypto winter that's coming. Joining us to discuss regulation and the current state of the crypto market is Morrison Foerster partner Brian Kidd, along with our very own David Hollerith. Brian, it's good to talk to you today. This comes at a time when we've seen hacks at crypto exchanges. We've seen stolen or plagiarized tokens as well. Certainly a lot of cracks in the system. And I wonder what you think this says about how regulators should be approaching this issue.
Well, thank you very much for having me. There's obviously a lot going on in the market right now. And I think you're seeing the way that regulation has played out over time is we're really seeing a decentralized regulation of the crypto market. So when you've got the different regulators fighting for their piece of the crypto pie, and you've got DOJ is very active in the space, SEC very active in the space, and the CFTC very active in the space. And you've seen some, rumblings from Congress as well, and some proposed stablecoin legislation that's currently in the pipeline. So there is a lot of focus in this space, but it's not kind of moving in the same direction at this time. And I think that's where you're seeing the cracks, and you can see things slip through without that focused regulation.
Hey, Brian. Yeah, it seems to me that given all these different pieces of regulation, the DOJ has been fairly successful at moving forward with sort of their own sort of enforcement actions. And I was sort of curious how much you think adding more clarity would help them accomplish their job. I mean, as far back as, I think February of this year, it's been pretty clear that they're moving forward. They have a task force that's specifically geared towards cryptocurrency, and they're clearly, rolling out indictments as we speak. So sort of curious how you think they fit into maybe clarity of regulation altogether.
I think having clear regulation generally is good for everybody. Here, obviously, the Department of Justice has taken a very active role. They, in February, I think, as you referenced, they appointed the first director of their national cryptocurrency enforcement team, which I think is a key part of the Department of Justice's focus at this point. And while I think, additional regulation or clearer regulations would be beneficial, it's not going to stop the Department of Justice from, continue to investigate and prosecute individuals and companies that they perceive to be, bad actors or committing fraud in the market. And I think you've seen that with the enforcement team, but also there's now a dedicated FBI team, the Virtual Asset Exploitation Unit. The department's continuing to put resources into this space, and I would expect that will continue to expand as cryptocurrency continues to play a bigger role in our economy.
Brian, it's Brian Chung here. Now, I just want to highlight that you were formerly the chief of the Market Integrity and Major Frauds Unit of the DOJ. When you look at something like the DOJ's announcement last week about insider trading happening in the NFT space with a former employee at OpenSea, one of these big marketplaces for those non-fungible tokens, what stuck out to you in terms of the DOJ's decision to characterize that as insider trading? Because that could have implications for perhaps the treatment of it as a security, right? So it's a very interesting type of dynamic that we saw in that announcement last week.
It was indeed. And I think this is, in the NFT space, this is kind of one of the first big moves. And using insider trading, it's using a traditional securities enforcement law to go after, the NFT marketplace, it's interesting and it's unique. And we'll have to see how it plays out because, obviously for insider trading, you're going to need that securities angle, which is why I think they've characterized it that way in the indictment.
Yeah, just to follow up on that too, if we're thinking about the OpenSea sort of indictment, I spoke with a lawyer about that, a former district attorney about it, and he had sort of brought up the fact that the DOJ is obviously quite busy. And then in this scenario where cryptocurrency or crypto assets in general aren't necessarily securities, some of them are, it's a little bit unclear, but the DOJ was sort of able to come in with wire fraud, money laundering, and sort of skate around having to distinguish what a crypto asset is. But I'm curious, do you think adding that clarity will help sort of the agencies work together, or do you think it's sort of irrelevant to the DOJ's mission of enforcement right now?
I wouldn't say it's irrelevant, but the DOJ is going to continue to enforce its traditional laws, which is obviously wire fraud, money laundering, those types of statutes. They're going to continue to enforce those wherever they see that they fit. But I do think, having clear regulations will allow, not that the SEC, DOJ, and CFTC do not work together well. I think they do. And you see that played out time and time again. But I think it will help them continue to move in parallel as they, look at these markets and look at the crypto assets and NFTs and decide, who and what conduct is running afoul of the established laws. And but by and large, I think DOJ is going to continue to do what they do, regardless of whether there are clearer guidelines put in place. I think they're going to continue to investigate and prosecute individuals that they believe run afoul of the current laws, which wire fraud, money laundering, those types of things.
A space to watch for sure. Brian Kidd, Morrison Forster partner, as well as Yahoo Finance's David Hollerith. Thanks so much for the conversation.
All eyes in the crypto space are on Capitol Hill today with a new bill co-authored by Senators Cynthia Lummis of Wyoming and Kirsten Gillibrand of New York that aims to add regulatory guardrails to the growing industry. They join us now along with our very own Jennifer Schonberger. Welcome everyone into the chat, into the conversation here. Senators, I want to begin with you, and particularly you both are moving forward in this with a bipartisan fashion, but how many other congressional colleagues have expressed interest in an understanding of cryptocurrency and then even furthermore, some regulation in cryptocurrency and even blockchain technology going forward? Senator Lummis, I'll direct that to you first.
The number grows on both sides of the aisle weekly between people who are interested and people who a year ago were paying no attention to this subject. And it's because their constituents want them to help create a regulatory framework that will balance innovation with an understood framework for regulation. So Senator Gillibrand and I have chosen the approach of integrating digital assets into the existing financial regulatory structure.
And so let's talk a little bit more about that and what additive measures will be taking place within this bill to address where there are some of the regulators who already have jurisdiction. The CFTC even had come out a couple weeks back saying that there are some instances where they can already take the action that is even being proposed in the bill right now. And what would your response to that be, Senator Gillibrand?
Well, that's exactly right. The CFTC has been doing the futures market for a while now, and we are clarifying that they will have the spot market as well for cryptocurrencies. We look at the purpose of these digital assets, and if the purpose is like a stock where you are offering it for money to start a company, like you'd offer stock in a company, that would then be clarified as a security. And so we follow the Howey test, which is the definition of what a security is, and we make sure that these digital assets can be analyzed in that framework. And so part of the industry goes to CFTC, part of the industry goes to SEC. IRS will have jurisdiction over all of it, and we will be able to create some basic safety and soundness, transparency and accountability, and consumer protections with this framework.
Senators Lummis and Gillibrand, Jennifer Schonberger here. Congratulations on finally dropping this comprehensive bill. It's great to see you both. Following up on that, how did you decide to distinguish? I know you said it's going to be based on the purpose and use of the token. Is that really the North Star that you followed for this? And how much support are you garnering across different committees, be it Senate Banking, Finance, Agriculture, as well as regulators on the chosen classifications to cede much authority to the CFTC in terms of classifying many of these de facto as commodities?
Well,
Senator Lummis, I'll direct that to you.
Okay, hi, Jennifer. We're going to see the number of cryptocurrencies that are regulated by the SEC be very large. But in terms of market cap, probably more of these cryptocurrencies will be regulated by the Commodity Futures Trading Commission, simply because Bitcoin and Ethereum make up about 65% of the market cap of digital assets. Nevertheless, there are thousands of cryptocurrencies, many of which are going to be requiring disclosures through the Securities and Exchange Commission, and they're very good at disclosures. So we hope that we have split, based on a very updated Howey test codification, the clear difference between what is a commodity and what is a security.
Senator Gillibrand, to you, on the back of the run that we saw in stablecoin Terra and sister token Luna, there have been renewed calls for regulating stablecoins. How does your legislation intend to prevent runs on stablecoins, protect investors? What it distinguish between algorithmic stablecoins versus fiat-backed ones? And would algorithmic stablecoins be permitted under your legislation?
No, under our legislation, we define a stablecoin as something that is backed one-to-one by a fiat currency. And so you would not have runs under that scenario. And that's the purpose of stablecoins. It's meant to be stable. So if you want to have a different kind of digital asset that has an algorithmic background, then you'd have to assess whether it would be a security or a commodity under the framework of what your purpose of that asset is. And just for your viewers, so you understand the breadth and depth of this industry, we have entrepreneurs who are issuing tokens in Oakland, California, as a democratization effort, as a way to organize a community, as a way to make sure they have access to social services and access to voting. So just because it's a digital asset, it doesn't mean it's being used for traditional monetary purposes or for financial services or for the many uses that we use both commodities and securities for in the economy. Sometimes their purpose is entirely different. And so we created this framework to be flexible, to allow for innovation, to allow for multiple uses or different uses. And if you overregulate this industry, the players you are going to exclude are those entrepreneurs and innovators who are using digital assets for all sorts of purposes. If you're a traditional player who wants to be a broker dealer and wants to offer financial services to institutions, you're going to be regulated by the SEC because that's the purpose of the SEC. But if you are doing something entirely different for very different reasons, you don't want to be overregulated because then you will stymie innovation and destroy so many applications for blockchain. Blockchain is a revolutionary framework and system that can be used for multiple uses. It's not just a one size fits all.
Okay, so just to follow up on that, Senator Gillibrand, because we've largely been talking about regulation for specific crypto asset types or blockchain-based asset types, but when we think more broadly around the blockchain and how the network can be its own internet, its own system and protocol, do you believe that we are marching towards a broader blockchain type of regulation or at least set of protections for consumers who are engaging?
Yes. And so that's why Cynthia and I worked very hard to look at all the current uses of blockchain technology and digital assets and tokens to make sure that there's a place for everything that is appropriate for what the purpose is and for what the goal of using that technology is. And this is a very useful framework to start. Now, in answer to one of your earlier questions, this is just the beginning. This bill will likely go through 4 committees of jurisdiction in the Senate. It'll go through banking for the SEC portions, agriculture for the CFTC portions, finance for the IRS portions, and most likely Intel because of the internet components. Most cybersecurity work is done through Intel. And so these committees will then use their judgment and put their imprimatur on this legislation over time, and that will make it an even better bill. And so Cynthia and I this is step one of a comprehensive, thoughtful view of how to begin to regulate this industry with enormous amounts of input from regulators, stakeholders, industry participants, entrepreneurs, so that we have in mind their design and their business plans and their goals in trying to find a regulatory framework that meets the needs of the moment. And given the market challenges of the last several weeks, you need these rules of the road to create stability.
Senator Lummis, following up on what Senator Gillibrand just mentioned, this is just the starting point. What kind of support are you garnering in the Senate from other colleagues on other committees? Do you see this legislation going through in a comprehensive form, or would you be breaking this up into more piecemeal? As mentioned previously, stablecoins are very much top of mind, maybe taking that piece out and shepherding that through committee. And how quickly do you foresee getting this legislation through, getting rules of the road through for the industry to get to the next level and to protect investors?
Well, Senator Gillibrand and I will be meeting with the Senate parliamentarian to discuss which committees will have jurisdiction, how the bill can be broken up to send components of it to the committees that have jurisdiction. The only committee that can assert jurisdiction over the entire bill is the Finance Committee. But because so many of these issues involve the expertise of the Ag Committee, the Banking Committee, and others, we think it will probably be preferable to divide it among the 4 committees that Senator Gillibrand mentioned. That said, Senator Gillibrand and I have been working with members of those committees to acquaint them with the framework of our work product. And so if the bill is divided up, we've already had either dinners or lunches or meetings or briefings with members of those committees to acquaint them with our approach. Some of them have seen the bill, some of them have received sort of executive summary, the cliff notes of
I believe
these bills, and we'll have the opportunity to weigh in. I think that this is a bill where you'll actually see committees function as they were designed, rather than having a piece of legislation go from the Speaker's office to the Majority Leader's office without the input of committees. This will involve rank and file members weighing in on a subject in their committees and passing them through committees the way that the Congress was designed to function on a bipartisan, bicameral basis.
A ton to keep track of here. We're going to have to end the conversation there for today, but we'd love to have you back and continue it. Senator Cynthia Lummis, who is the senator from Wyoming, and additionally, Senator Kirsten Gillibrand and Yahoo Finance's own Jennifer Schonberger. Thank you all so much for joining us here today.
Securities and Exchange Commission Chairman Gary Gensler expected to speak today with anticipation that he could propose changes to the way that your stock orders are carried out. Reporting from the Wall Street Journal yesterday suggesting that the SEC will require wholesalers to compete amongst each other on orders sent to them by brokerages like Robinhood. But how does all of this affect the bottom line for the brokerages that retail traders are familiar with? Let's bring in Devin Ryan, Director of Financial Technology Research at JMP Securities, a Citizens company. Devin, great to have you on the program this morning. I know that you watch the stocks that are kind of linked to the brokerage industry. How important do you think the changes are, as originally reported, to the industry when it comes to the bottom line?
Hey, Brian, great to be here as always. So, first off, what I would say is that, payment for order flow is another topic that I think is getting a lot of attention here over the last few days with potential proposed changes. And honestly, we need to see more details to have, a more detailed view here. But anything that's going to drive more transparency in the industry and better execution in the industry, I think should be applauded. But what I would also say is that there's been a lot of initiatives taken even over the past couple of years that are driving in that direction, whether it be on the transparency side, enhanced disclosures on 606 reports, which is where brokerages share the market making data that of the partners that they work with on that front, or on best execution, where there's been a record level of price improvement where retail investors are getting even better prices on their execution. And so I think we need to be careful what we wish for. Market structure is really complicated. And if you change one very small piece of it, it can have ripples through the entire system. And what we've been writing really over the past couple of years is that if you make a big change here, that's going to benefit the biggest firms. So I think perversely, everyone thinks that you change payment for order flow or how trades are executed, and that's really bad for firms like Robinhood or Schwab or some of the others. In reality, what that will likely do is push them towards internalizing their own trades. So the scale players have enough flow where they can execute those orders themselves if they have their own market making capabilities. Some firms are already doing that, like Fidelity. What it will do is significantly hurt the small brokerages that are trying to scale, and also deter new firms from coming in and trying to disrupt the existing system. So, I think it'll be interesting to see where we go here. We don't think that payment for order flow will be dramatically affected, because I think the SEC understands that making a big change there could have some pretty negative ripples through. But we do think that anything that comes out of this that is related to more transparency, which I think would help investors feel more confident that the markets are fair, or even better execution if there's ways to do that. We think that could be a positive for the overall industry, and I think people would be supportive of it.
Yeah, Devin, let me follow up on that, because everything we know so far is based on reports. We haven't heard from Gary Gensler himself just yet. And yet yesterday, we saw Robinhood down well over 5%. I mean, you've just made the case that maybe that was a bit of an overreaction. But how do you think investors should be looking at these changes in the context of names like Robinhood?
Sure. Well, the market almost always overreacts. Your payment for order flow in the headlines is not a new thing. And if you can go back over the last 5 years, every time it comes up, you tend to see negative reactions in stocks that are highly tied to trading. So it's not surprising. And it's also a very complicated, nuanced topic where people, again, immediately react that this is a big negative without thinking through that there's other remedies these companies can take. In reality, there's value to their customer base that they have. And all of these firms, whether it be the market makers or the brokerage firms or the exchanges, they have to make money in some way. And I would argue that the retail investor has never had, if you think about the direct and indirect costs of trading, a better opportunity in the market than they do today. Prices overall, direct and indirect, are probably down 75% if you think about the cost and the friction in trading just over the past couple of years. So, I do think that when the dust settles here, it'll be okay for those firms. But we've seen this many times where market doesn't like uncertainty, and right now there's some uncertainty because we don't know exactly what the proposals entail and how that will be executed. The other point is that to the extent there is a negative normal kind of initial reaction here, if there are remedies for firms like Robinhood or Schwab that ultimately could be positive, it'll still take time to move those forward. And I think that's another potential risk in the near term.
Okay, well, I'll be watching for those specifics out of the SEC. Devin Ryan, as always, appreciate your time. Director of Financial Technology Research at JMP Securities, a Citizens company.
Campbell Soup Company says higher prices boosted sales even as it sold fewer items in the latest quarter. With more on their outlook, Yahoo Finance's Brian Sozzi sitting down with Campbell's CEO, Mark Klaus. Soz?
All right, thanks, Dave. Mark, thanks for joining Yahoo Finance. So a good quarter by Campbell Soup and your team. Organic sales up 9%. Going through the quarter, margins up, the sales were up. And I can't help but to think, do you think you have a recession-proof portfolio?
Well, look, I think historically speaking, first of all, great to be here with you too, Brian. Appreciate being on. I do think when you think about our portfolio, and this is actually true, I'd say, on our meals and beverage business as well as our snacks business, we have performed very well in a variety of difficult economic environments. And why that I think is true is, first, on the meals and beverage side, we tend to have categories that even in a world where people are experiencing economic pressure and maybe trading down or making some compromises in what they're purchasing, our categories tend to be good destinations for those values. So if you're eating out less or you're trading down for more expensive choices into categories like soup or pasta sauce, we consistently do very well. I think what's also interesting is on the snacking side, one of the things that in a lot of years of snacking that I've come to learn is that in times where things are high pressure, those comfort foods, those favorite Kettle potato chips or Milano cookie stays in the basket. And we've seen so far through the journey we've been on that that's consistent, even in the face of rising prices, as we've needed to move some prices to match inflation.
Well, Mark, I could say, I have a stressful gig too, and I've definitely consoled myself in some of those Old Bay goldfish snacks right behind you. Don't think I didn't see those, but I'll talk about that.
Yeah, we snuck that in.
Yeah, no, we'll talk about that. We'll talk about that in a second. But you did mention, you talked a lot about in the earnings call price elasticities, and I guess another way to break that down or look at it is how consumers are responding to price increases. So how are they responding right now when they go into the supermarket?
Yeah, I would say we are experiencing some elasticities, but significantly lower than historical levels. And I get asked a lot about why I think that's the case. And I think there's a couple reasons why. The first is that probably not a lot of periods in history where we've seen the broad-based nature of the inflation that we're experiencing now. In many cases, you'd have one particular commodity or one space that was feeling inflation. Consumers could potentially move between different options to meet different occasions and do that in a fairly kind of value-driven way. I think because inflation is so broad across the industry, we're seeing a little bit more of a level playing field. I think the second reason why we're seeing it is, as I said before, I think our categories are fairly well positioned when consumers are starting to run into higher prices. I mean, I'll take a good example is Chunky Soup, where even though we may be in the mid-teens for pricing right now, that's on a $3 can of soup. It's still a tremendous value when you think about what consumers are getting. So again, although we may see some pressure in trading down as prices are going up, I think we've been a bit more resilient, and I think both of those reasons are playing into it.
Did I hear this right on the call? You are now looking at a third wave of price increases?
Yes, it's true. So we're through 2 waves that are in market already. We announced a third wave in April and have been working closely with our retail partners on that. And, you know, the fact of the matter is it's reflecting the inflation increases that we saw more recently. And although I think this will be, you know, far more specific or strategic in nature relative to where that is coming from, and in particular areas like cooking oils or wheat and flour is where we've seen more of the recent inflation. I think there is still a need as we kind of think about getting that balance right. Now, I will say as we continue to move forward, we want to make sure we're using the full tool bag to try to address costs. So it's not all about pricing. I think it's very important, and we remain very mindful of protecting value for consumers. And so things like productivity are really important. And I think perhaps the thing I'm most excited about in the third quarter was the response of our supply chain and the continued improvement in our execution and performance, because that gives us a platform to continue to work on productivity and identify ways that we can drive savings so that we're not entirely dependent on pricing. And I think that balance is something that going forward, although we're expecting to see headwinds as far as inflation, I think we'll be able to utilize a variety of different levers to address it.
Mark, this is the first time you've been on Yahoo Finance, so of course, welcome. So I have to ask you this question. A colleague wanted me to ask you this. Tomato soup, what is better to put in there? Is it water? Is it milk?
Well, it's a little bit of personal preference. I will tell you that my preference is milk, but a lot of people love it with water as well. And you know, you gotta adjust it to your own taste. That's the beauty of condensed soup. You get to choose.
Indeed you do, and recently I chose some of your spicy, chunky soup, and it definitely kicked me in the back of the throat. In a good way. We'll leave it there. We'll take that offline. I'll shoot you an email. Campbell Soup CEO,
great.
Mark Klaus, good to see you. We'll talk to you soon.
This week, mortgage demand fell 21% year over year, hitting the lowest level since 2000. This is the latest sign of a cooling housing market, and here to talk more about the state of real estate and his newly renamed company is Anywhere Real Estate CEO and President Ryan Schneider. Ryan, great to have you here with us today. From what you're seeing, kind of across the board here, what does this signal to you about the consumer and where they are starting to push back on some of the prices, as well as the financing options that they have available to them?
Well, first of all, thank you for having me. It's great to be here under our new Anywhere brand name as a company. You know, it's a really strange time in the housing market because you've got this combination of rising rates, but you still have very substantial supply constraints. And, you know, we just don't have enough houses, and there is demand for more houses. And so what we're seeing is definitely some real slowdown, especially in the first-time home buyer and the mass market part of the market, in large part driven by the higher mortgage rates. But we haven't yet seen as much slowdown in, say, the luxury part of the market, where there's a lot more all-cash offers and transactions happening. And there's still some certain geographies like a Florida, like a Texas, like a Southern California, where the market seems to have more momentum than kind of some of the places that are struggling a little bit more with the rising rates. So this combination of rising rates and a supply constrained environment is a little different than some past housing challenges we've seen. And it's leading to some different outcomes by both customer segment and geography.
Hey, Ryan, it's Julie here. Can you give us a little color or quantification around what kind of pullback, where you are seeing the pullback in demand, how big it is, how severe it is?
Yeah, look, the biggest pullback, as I talked about, is really in the middle part of the market and the first-time home buyers. We've seen the kind of 20% drop in mortgage applications like you talked about. Our data through kind of the end of April that we publicly disclosed talked about, how listings were down and kind of how units were down, in like the 10% kind of range. And that's what we've been seeing, and that's where we've seen the biggest impact. We also saw luxury listings actually go up, 500,000 and up. They were up, but have still been up. And so it's really varied, but that gives you a bit of the magnitude, both, on the mortgage side, but also in that kind of mass market first-time home buyer, where the impact has really been the largest.
Ryan, a couple more rate increases from the Federal Reserve. What does that mean for your business?
Well, obviously it's a headwind. but it's a different kind of headwind with that supply constraint that I talked about. We've seen a huge shift in people into adjustable rate mortgages, right? And that's been one of the biggest things that's happened here as people are still trying to buy houses and find the place to live that they want to live, but dealing with higher rates. And so, in the parts of the market where mortgages are the biggest, we totally expect that to continue to be a headwind. On the flip side, as the Anywhere company, we go to market with some great brands, including Sotheby's International Realty, Corcoran, Coldwell Banker, that tend to skew luxury. And so, we've seen a little more momentum still in our business because the luxury part of the market, where there's a lot more cash offers, has been a bit less affected than what we're seeing in the mass market and the first-time home buyer.
Okay, and so for that first-time home buyer, where we're also marrying this with some of the CPI data that's coming out, really showing us a sense of where those shelter costs, quite frankly, for consumers are becoming far more expensive now. When is that going to finally show up in the data that it's coming down and that it is affordable for the first-time home buyer who is then getting pushed back into perhaps the rental market?
Yeah, I'm concerned that it's not going to show up in the data and it's not going to come down because as a country, we just don't have enough houses. We're dependent on the number you look at, 1, 2, 3 million, units underbuilt. Unlike 15 years ago when there was a housing crisis and we were like 2 or 3 million units overbuilt. And again, it's not just the price of purchasing houses. You can see the same increases in pricing on the rental market. Right. And so I'm concerned for all the first time buyers that there's not going to be a pullback in the pricing, in part because, there's just not enough supply. And we see it showing up in both the purchase prices of home, but also the rental prices. And so I worry for that consumer segment a lot. And, we as an industry leader do everything we can at the state and federal level to advocate for more homes being, built and brought to market.
Lochman Otchathan is with us now to talk more about all of this. Economic Cycle Research Institute co-founder.
Hi.
So what you do is in the name of the organization.
Yes.
Economic Cycles is where your expertise lies.
Yep.
So are we going into a recession? When is it happening? How should we be thinking about this, especially with the numbers this morning?
Sure. Well, I think these numbers reinforce our earlier outlook that odds are we are going to go into a recession. The question as to when is just not yet, but it's super tantalizing, but it's there because of the kind of information that we're seeing today, right? The Fed is going to be super hawkish. I think we just concluded, right? As a result of these continuing highs in inflation. So that makes for a really odd mix. You don't have to be an economist to figure this out, right? The economy is slowing, consumer confidence at a record low. You don't want to hear that. At the same time that the Fed is stomping on the brakes, what's going to happen, right? The odds are you could slow too much. And they really just have a choice of policy mistakes or errors. There's no right way out of this. We wrote back in January that because they were so late in going after inflation and kind of slowing things down, they now are trying to make up for it or catch the train, but the inflation train left the station a long time ago, and we're seeing that kind of build here. So as a result, the US Fed, other central banks around the world, everybody's tapping on the brakes. We're all going to slow, and I think we all know the odds are really high here of a recession.
Mild recession or something bruising?
First off, I just want to say it's super hard to predict a recession. I know a lot of people are predicting them. I just got to tell you, it's super hard to do this. We have a pretty good record of doing it. And so I think it's meaningful that we're saying that there's a recession in front of us. Now, as to mild or severe, a lot depends on the nearby shocks, right? By definition, you don't know what they are. We think we know what they are, right? Some pretty shocking things have happened, and they may persist to make a recession more severe. On the other hand, you might say, well, some consumers have money saved up. Some businesses have decent kind of balance sheets. So,
and most people have jobs.
And most people have, well, the job market's pretty tight, let's say. So therefore, this could mean a mild recession. I don't think that's knowable just yet. One of the things that we're seeing from our research, because we do look at 22 economies around the world, is that there is a setup for a more severe recession, a more international recession. And the last time we had that would have been like the early 80s, which is after the inflation of the 70s. So there you go.
And so within that context, as we're thinking about where this leaves employees, but also consumers, because at the end of the day, those employees are daily basis consumers on everything from gas to food items, and they're looking across the board at where those price increases are being felt. So in the wake of, or at least leading up to a recession, how they're feeling is going to be even more so priced into the markets well ahead of the actual recession showing up in the GDP print.
Yeah. So 100% right. And I'm glad you brought up, like, what do consumers do, right? First off, as you were saying, job market's hot. If you don't have your dream job, get your dream job. If you're in it, hang on to it, just solidify yourself. It's a really good time to be doing that, number one. Number two, save for a rainy day. If you can, start to sock away or beef up your savings a little bit because things are likely to get more volatile. A growth rate cycle slowdown, just a simple garden variety slowdown, you can get 10, 20% corrections in equities. A recession, you're more in bear market territory. And when you go back to the consumers, let's oversimplify and say there's lower income is a half or more, and then upper income to various stages is the other side. Lower income, very strapped already, right? Because it's rent, it's food, it's energy, it's everything that you need, takes up the whole budget. Wealthier consumers may have some exposure to equities or home prices that have been rising. If those start to wobble, they get a little edgy and start to pull back. And you'll see it, even though nominal numbers can look good, the company's going to come out and say, oh, look, nominally we did these blowout numbers. Look at the actual amount of stuff, right? There's less chips in the bag, even though the bag still costs $2. And people will start to move on discretionary things, like you won't use a fresh can of tennis balls every game. You'll use them for a few games. That's the kind of stuff that starts to seep in.
You said a moment ago that the ingredients are sort of in place to potentially have a worse global recession. What are those ingredients? What would need? Walk us through what would need to happen to get there.
Okay, so we enter this recessionary window of vulnerability. I think we're edging toward that pretty clearly. Then you have shocks that are occurring inside the window of vulnerability. We already have the energy shock. If it persists, that verifies. That could be part of what makes a recession sharper. You could have a market event. That's a type of shock. You could have a geopolitical event. Look at what's going on in Europe. I mean, I know it's kind of slipped a little off of the major headlines, but that's still percolating. Those kinds of impacts you see coming full circle, and in today's report, food is up, energy is up. So these are the kinds of things, and there's some interesting things happening with currencies and these central banks around the world. There's things that can move very fast. In the summer of 2008, August of 2008, before Lehman blew up, our international indexes, leading indexes, now I'm talking forward-looking, where's the puck headed? Those indicators went to recessionary readings, and then Lehman blew up. So that combo, in retrospect, was the recipe for the Great Recession. Okay, we have to wait and see.
If we get that recession, who bears the most blame for it? Is it Jerome Powell at the Fed or the Biden administration?
Oh yeah. So look, they both have their fingers near this, right? So you want to support the economy coming out of the pandemic and the deep COVID recession. There was we called an inflation cycle upturn in September of 2020. That's 21 months ago. The Fed hung out with the transitory stuff, keeping that going all the way until November of last year. So that's very late. And the same thing with the kind of fiscal response. There's things early on that were super helpful. I think people see that. But then more recent stimulus, you're kind of pushing on the gas when the inflation cycle's already running up. I think the fundamental issue fundamental from where I sit, I study cycles, is that I don't think economic policymakers understand that inflation is cyclical and that that's different than the business cycle. It's a fundamental kind of concept. I think a lot of non-economists can understand that, but actually, after you've become an expert in modeling, it's a little tougher.
Well, on that happy note, let's go get some shots. Let's go get some shots and have a great weekend. Okay.
We've survived all of this stuff in the past, and we're going to survive it again. I have no doubt. And this will set us up for stronger growth. But unfortunately, some of the more vulnerable get hurt during a recession.
All right, I like leaving on that. Let's leave it on that note. Lochman Otchathan, Economic Cycle Research Institute co-founder. Good to see you. Appreciate you coming down.
Thank you.